Welcome back to Investing Talk Podcast. We are launching into a deep dive today that tackles, well, one of the most dynamic shifts happening right now in the technology sector. We're talking semiconductor reshoring and that whole national security focus.
Exactly. Today we're looking at SkyWater Technology. And this isn't just another chip company, This company is mid-pivot, leveraging its unique position as a U.S.-only technology foundry. We need to frame the so what right from the start for you. This company is a custom chip specialist for these crucial high-growth sectors: national security, quantum computing, AI, advanced packaging. Their recent moves haven't just increased revenue, they've fundamentally changed their scale, their entire strategic indispensability.
And when you talk about fundamental shifts like that, from, say, a contract manufacturer to a strategic asset, that's where the real multifold returns can hide. It forces a complete reassessment of the valuation model. We have a massive amount of material here: financials, technical charts, analyst sentiment, and we're going to pull out the most important nuggets for you. As usual, before we start, subscribe, like, and comment to this video to support the show and keep informed on these really rapidly moving sectors.
Okay, let's unpack this. We're calling this the inflection point, and we have to prove it with the numbers. So let's start this deep dive by looking at the fundamentals. The numbers SkyWater just put up are, well, they're genuinely impressive. They really signal this operational transformation is absolutely real.
Impressive is. I mean, that's actually an understatement.
It really is.
They reported a record Q3 2025 revenue of, what, $150.7 million? That kind of growth trajectory is staggering. We're talking 155% quarter over quarter.
And 61% year over year.
Right. And they didn't just meet consensus estimates, which were already pretty aggressive. They blew right past their own guidance of $130 to $141 million.
And we know exactly the physics behind that explosion. The major driver wasn't just, stellar organic growth. It was the strategic, immediately accretive Texas facility acquisition. That contributed a huge $86.6 million at the total. They didn't just earn growth, they bought it, but they also bought capacity and efficiency.
Right. So the question, as the resident skeptic, is always the same when a company acquires massive revenue. Are they just buying top-line vanity? Or,
right. Are they buying profitability?
Or are they buying real underlying profitability? Is this scale coming with crushing debt servicing or, improved margins?
They are absolutely buying profitability and scale leverage. If we look at the non-GAAP metrics, this is where the story gets really compelling. Their gross margin expanded sharply to 24.6%. Now think about that increase. It's well above their previous guidance, which was down in low teens, like 11 to 14%. That sharp expansion shows they're leveraging the new scale immediately.
And we need to pause on that gross margin expansion. That's the true signal of pricing power and, operational synergy.
Precisely. And the margin leverage translates beautifully down to the operating line. Adjusted EBITDA, and for a scaling foundry company that needs massive equipment, EBITDA is the metric to watch. It strips out all that heavy non-cash depreciation and amortization. Well, adjusted EBITDA reached $25.8 million, or 17.1% of revenue. This metric more than doubled the previous quarter's EBITDA.
That is the engine starting up with twin turbochargers. I mean, going from a $2.3 million EBITDA in Q2 to nearly $26 million in Q3. That is the definition of leverage. But for a company taking on debt to scale, are we certain that high EBITDA is translating cleanly into free cash flow yet? Or is that more of a future promise?
It's a future promise, but one that's secured by long-term capacity. The near-term focus is clearly on maximizing top-line growth and market positioning. But the market believes in the trajectory because the future outlook is just as strong. They already provided impressive 2026 baseline revenue guidance of at least $600 million, alongside $60 million in adjusted EBITDA. This sets a clear floor for massive accelerating growth over the next 12 to 18 months. So the market has visibility far beyond just the next quarter.
Okay, $600 million is massive, but long-term sustainability is always the challenge in this hyper-competitive semiconductor sector. They've captured a lot of market share quickly. So what's the long-term competitive moat here? What prevents Asian foundries or even larger U.S. competitors from eventually eating their lunch?
This moat is extremely deep, and it's strategic. It's geopolitical, not just technical. Their core strategic advantage is their U.S.-only operations, which is crucial given the current reshoring mandates and, the CHPS Act dynamics. They specialize in highly customized DoD-aligned processes and these custom chips for quantum computing, national security AI, and space applications.
So if you're the Department of Defense or a defense contractor working on sensitive classified projects, you functionally have to go with a U.S. specialist like SkyWater. Competitors operating overseas are simply They're blocked by security requirements and supply chain risk.
Exactly. Think of it like building a secure vault door. Once the DoD or a classified contractor decides on a specific proprietary locking mechanism, that is, a highly specialized secure process based on SkyWater's intellectual property, they can't just switch to a competitor's hinge system overnight. The cost, the time, the security clearance barriers are just immense. So that Texas Fab 25 acquisition didn't just add $86 million in revenue. It provides capacity for $75 to $80 million in quarterly revenue, essentially securing this market share. It makes them an indispensable cornerstone amid these massive U.S. reshoring trends. That level of defensibility is what justifies a higher valuation multiple.
The scale and geopolitical positioning look rock solid, but often the market doesn't wait for fundamentals to fully catch up. So if the numbers are the engine, what's the price action telling us about investor conviction right now? Let's pivot away from the balance sheet and look at what the charts are screaming.
The charts are showing massive, just undeniable conviction. This stock has been on a tear.
We've seen incredible high momentum. The stock hit a 52-week high of $30 multiple times in January 2026, and it's currently trading right near that peak. To put that momentum into context for you, it is an astounding 524% above its 52-week low. That is not a recovery. That's a structural breakout driven by belief in the new business model.
What's fascinating here is the sheer magnitude of investor confidence that's supporting that price action. They delivered 148.15% one-year returns, and that recent double-digit daily gain of 10.2%. It just reinforces the psychological state of strong demand. And crucially, the trading volume supporting this move is exceptionally high. That signals that institutional money is validating this strong uptrend rather than it just being, a retail frenzy.
But this is where the skeptic flags come up. When we see a move of that magnitude, we have to look at the technical indicators for fatigue. The data clearly signals an overbought relative strength index, or RSI. So while momentum is absolutely roaring, we have to acknowledge that the price may be technically stretched in the immediate short term. A 500% move in a year, it just demands caution.
That is absolutely a necessary check. The RSI is a momentum gauge, and overbought just means the stock has climbed too fast, too quickly. It suggests a near-term cooling-off period might be necessary before the next leg up. However, strong momentum driven by a fundamental change-like doubling capacity overnight often ignores those overbought signals, at least until a catalyst fails or the macro environment shifts. It's the classic dilemma. Technical caution meets fundamental conviction.
Which brings us perfectly to market psychology and sentiment. If the technical charts are flashing green with a hint of caution, what's the detailed narrative supporting this fire?
The narrative has solidified into one simple word: inflection. If we look at the quantitative scoring across recent news items, financial blogs, the weighted sentiment is strongly bullish. It's averaging about a 0.43 score, which is quite high. Every major headline confirms that the market believes the scale increase is permanent.
That's a strong score. But Wall Street analysts are notoriously slow to catch up to these dramatic inflection points. What about their professional consensus?
That's the disconnect. The consensus is a moderate buy, but their analyst buy rating, the ABR, is 1.71, which translates well into the strong buy category. But their official consensus price target is $21.50. Given the recent price action near $30, this suggests Wall Street is absolutely playing catch-up to the operational reality. The institutional target reflects the stock before the market fully digested that Texas acquisition and the Q3 beat.
They are definitely chasing the tape. So what were the specific recent catalysts that fueled this sentiment surge beyond the balance sheet numbers?
Well, beyond the massive Q3 earnings beat, which validated the scale, they announced a significant partnership with Qualcomm. It's focused specifically on quantum computing electronics. That connects the operational success directly to the most exciting, highest multiple sector in computing right now. It provides immediate earnings and a high-growth speculative narrative.
And if we connect this to the bigger picture, there's a massive speculative element here. I mean, the quantum foundry ambitions could accelerate rapidly, especially driven by this alignment with DoD funding and national security priorities. The market loves that combination of tangible earnings, that $600 billion floor, and future-proof speculative potential in areas like quantum and AI security.
The narrative has fundamentally shifted. It's gone from a specialized contract manufacturer struggling to find scale to America's sovereign chip provider for the future of specialized warfare and high-performance computing.
Right.
That narrative shift is priceless for long-term valuation.
Okay, let's switch gears and focus on the risk side of the equation. We've established the growth story is massive, but no story is without friction. So what are the speculative hurdles that could absolutely derail this massive uptrend, at least temporarily?
The primary risk, as you flagged on the technical side, is pure valuation risk. The stock is currently trading above several established fair value estimates, which sit roughly between $21 and $29. And when you trade above analyst targets, you are vulnerable to bad news. This is coupled with the rising short interest, which has hit 11.34%.
11.34% is high enough to signal conviction on the downside. That means the bears firmly believe this is a classic momentum trap that will revert to those lower fair value ranges. That level of short interest also introduces significant volatility risk, doesn't it?
It does. A high short interest is a double-edged sword. If the company hits or exceeds that ambitious 2026 guidance, you could see a massive short squeeze propelling the stock even higher. But until then, that short interest is heavy selling pressure.
But what about the near-term earnings picture? If they're guiding for $600 million in 2026 revenue, they should be posting profits now, right?
This raises a crucial question for investors who only look at the bottom line. Despite that stellar revenue guidance, the immediate Q4 EPS guidance shows expected losses guidance is for negative 0.08 cents to negative 0.04 EPS. And while revenue is projected high at $155 to $165 million, the market might initially react poorly to that short-term negative earnings print. It just implies heavy scaling and integration costs.
So high growth, high revenue, but still some red ink on the net income line for the quarter. That's a classic scaling trade-off. What are the secondary operational risks we should be mindful of beyond just the numbers?
Historically, they have dealt with timing issues related to government contract delays, which can suddenly halt revenue recognition, and also a reliance on debt financing. Both of those have caused sharp price drops in the past. When you rely heavily on specialized government work, timing issues are always a factor, even if the money is secure long-term.
That's a complete picture of the downside.
Right.
So how do we offer a counter-narrative to those risks, especially the short interest and the near-term losses? How can an investor justify holding through that volatility?
We have to understand that the losses are a function of investment into future scale, not weakness. The near-term losses appear to be already baked into conservative guidance, meaning the market expects them and has already priced them in. And critically, we have to look at the balance sheet benefit from the acquisition. The $110.8 million bargain purchase gain they realized from the Texas acquisition that provides a massive turnaround buffer.
We need to unpack that jargon for the listener. What exactly is a bargain purchase gain in this context?
It's essentially accounting profit. It's realized because they acquired that Texas asset for significantly less than its fair market value. In this case, $110.8 million less. This is a unique, non-cash accounting benefit that materially cushions their future growth costs. It provides immense liquidity and effectively de-risks the future operational ramp-up necessary to hit that $600 million revenue floor in 2026. They are heavily capitalized for this growth phase.
That changes the risk profile substantially. So after dissecting the massive growth, the roaring charts, and the potential risks, which seem manageable given the massive scale, where does that leave us?
It leaves us with a high degree of confidence that this stock is in the early stages of a true breakout. We are assigning a bullish score of 8-10.
That's a strong number, especially considering the technical signals of being overbought and the high short interest. Give us the final investment thesis, the elevator pitch that captures this story.
SkyWater's story is simple. Their record Q3 revenue beat, combined with the Texas acquisition doubling their scale, firmly positions them as the essential U.S. chip foundry leader in critical, high-growth areas like quantum and AI security applications. The strongly bullish sentiment and the aggressive $600 million revenue guidance for 2026 absolutely outweigh the current overbought risks and near-term valuation concerns. This is a company executing a massive government-backed pivot.
So what's the recommended approach and target horizon for listeners who want to position themselves now?
We recommend treating this as a swing trade into the Q4 earnings call because momentum is strong and a beat could spark that short squeeze. And then holding through the 2026 ramp up for multifold upside potential, that's when those operational synergies and the full scale truly hit the income statement. This is a story that plays out over the next 12 to 18 months.
The knowledge is most valuable when understood and applied. So here's a final provocative thought for you to consider, based on the macro landscape. We know the U.S. government is aggressively targeting supply chain resiliency. How much faster Could SkyWater's quantum foundry ambitions accelerate if policymakers decide to radically ramp up national security funding, specifically targeting resilient domestic semiconductor supply chains?
That is the ultimate tailwind. We are watching a company align its business model perfectly with a multi-billion-dollar, non-negotiable national priority. That macro policy driver favors them unequivocally.
That is a compelling thought to end on. And that's our time for today's analysis. Thank you for joining us for this deep dive into the numbers and the narrative. Remind yourself to subscribe, like, and comment to stay updated on the critical sector rotations driving the market.